Today, we got overall household debt for the first quarter coming out rising 0.9%, growing over $17 trillion. That's according to the New York Fed. That's the latest data on that front. Joining us now to break down the consumer sector is Keith Lerner, who's Truist Chief Market Strategist. Excuse me, Keith. Thanks so much for joining us. Let's get right into just kind of this latest data that we had come out today from the New York Fed. What's your assessment of that?
Hey, great to be with you, Diane. And Sean, regarding the New York data, which one are you talking about specifically, the household data?
Yes, the household credit.
Yeah, well, I mean, I think what we're seeing a little bit is household debt is normalizing from very low levels. So I think the consumer's balance sheet in totality is still relatively healthy. But our view is as the compounding impact of these rate hikes in conjunction with tighter lending standards, will filter into this market and the economy in the second half and slow things down. But I think it's going to continue to be a gradual move down, especially if you think about this year to date, we've averaged almost 250,000 jobs a month. So I think in that environment, which is still much stronger than before the pandemic, I think the consumer will hang in there. But again, we expect a gradual decline or pullback as we move into the second half.
Keith, when we talk about sticking with New York here with the manufacturing activity, that number that we got out this morning, certainly we did see a slump in activity. I know you were saying that maybe the momentum that we had seen, the resilience here in the consumer, we might start to see that picture shift a little bit. What do you see just in terms of manufacturing and how that's going to factor into this economic slowdown?
Well, I think we've had this divergence already in the overall economy, and folks that are looking at the manufacturing side, a lot of that data has been weakening for some time. We've had this divergence between manufacturing that's been weakening versus the services that has stayed relatively strong. I think when you see things like the Empire reading this morning, those regional surveys tend to be extremely volatile, but I think the message is that continues to be the weak side of the economy. We expect that to continue to be some weak. I think later on this year, we expect the services side to show more of a slowdown as we expect initial jobless claims to actually start to perk up. And that's one of the things we're watching more closely real time on a week-to-week basis. Last week, there was some funkiness in the data as far as the initial claims. But I think if you're looking forward, then two main things we're focused on is initial claims and then also credit trends. We're starting to see default trends move up on the margin. And again, that just tells us that things are slowing down.
So, Keith, I got to ask you, before we kind of dive into the earnings in the week ahead, we've got a big focus on retail this week. But before we dive into that, let's kind of broaden this out to you talk about, are we in a new bull market or are we experiencing, outside of kind of recent trends we've seen over the past 2 weeks, are we experiencing a bear market rally?
Yeah, it's an interesting question because we're about 7 months off the low. And what we did in a recent publication is we outlined the bull and bear case. We are more on the defense side. So let me lay that out firsthand. But if you look at the October low, I will say you had some things that were consistent with a market low. You had really negative sentiment. You actually found the low on a sky high inflation number as well. And you've had a nice move off the lows. But I will say other factors, I think, leaves in question if this is a new bull market. Normally, the first phase of a bull market is like a rocket ship. It takes off. You're up on average over 30% by now. We're only up about 15%. Also, small caps, cyclical areas of the market tend to lead. What do we see right now? Small caps are underperforming by a wide margin. Transportation stocks are underperforming as well. And then financials are also underperforming. So if this is a new bull market, it's not nearly as strong as most bull markets at this same stage, 7 months off the low. And some of these more cyclical areas aren't showing strong performance. And the breadth of this market is still relatively weak. So we're still skeptical. I think to keep it more simply, I think we still think we're in this broader, choppy trading range. And it's not at this point, it's not a compelling opportunity from a risk reward standpoint.
Keith, what's going to get us out of this very narrow trading range?
One, maybe this debt ceiling that we're talking about. I think one of the best things for the bull case is positioning is still relatively short this market. So listen, I think the most likely view is that this whole debt ceiling and fiasco gets kicked into the fall, where you actually have then the appropriations bill and the budget for next year, where you're more likely to run into something like a government shutdown. But I will say, if we, on the upside, I think maybe a more positive resolution. If you break above 4,200, that would bring in some technical trading. But more or less, I really think we're trapped, about 3,800 on the downside in the near term. And then if we break above 4,200, I still think the upside is probably capped to around 4,300. So I think we're here for some time. And I think really what it's going to be is, how you're positioned within the market. And for us right now, we're overweight things like technology, communications, and also more defensive areas like staples.
Okay. Speaking of staples, you mentioned you're overweight consumer staples. We've got a big week ahead earnings season rolling on this week with a lot of retailers out. You've got Walmart, Target, and Home Depot all set to report their latest quarterly numbers in the coming days. Again, you mentioned you're overweight in the consumer staples. What are you expecting to see this week?
Yeah, I think the earnings will be okay, right? I mean, going back to if we have 250,000 jobs, or we're creating 250,000 jobs a month, that's well above the average. I think the consumer is still okay, but I think you'll continue to see this trade down, which we saw last quarter, and that should benefit, some companies on the margin, like Walmart relative to Target, just seeing that trade down. And then I think it'll be more interesting, like Home Depot, if you start to see, people are locked into their home with their 3% mortgages. Are you seeing folks, do more renovations? Because if you look at the stocks there, they've been relatively flat the last couple of months.
Keith, how do you make sense of the consumer as of late? Because when you take a look at the retail sales numbers that we're going to get later this week, it's actually supposed to grow for the month of April. Yet, like you're saying, we have started to see the consumer trade down just a little bit. When do you expect to see more of a material impact on some of these retail names?
Yeah, our view is that you'll start to see more of a slowdown in the economy in the second half. That's consistent with when the yield curve inverted last year. That's also consistent with the lagged effect from Fed policy. And then more recently, if you think about the tighter lending conditions, that also works with the lag. So, our perspective is we'll start to see more of that pickup in the unemployment claims in the second half, and that will weigh on some of these retailers, and the retailers in general tend to be more cyclical in nature. So I think right now, the economy is, continue to move forward, to kind of grind forward. So therefore, these stocks have done the same thing. But I think as we move into that, later stage of this year, we'll start to see some of that weakness manifest itself. And that's why we're right now, we're neutral, the discretionary area. But if you think about staples relative to discretionary, staples are less economically sensitive. And that's one of the reasons why we like that sector more relative to discretionary.
It's kind of a need, not a want. I get that.
Exactly.
All right. So besides earnings, we've also got some deal flow activity in focus. Today's big headline really seems to be deal flow activity when it comes to big deals like Microsoft and Activision. You also had some big activity in energy and gold mining. In terms of Microsoft Activision, you had news out today. The European Union regulators have approved the proposed $69 billion acquisition. What's your take on how deal flow activity factors into your outlook on the market action?
Yeah, I think about the ones you discussed today, they're really not related. They're one-offs on specific situations. I think as the economy slows down and some of these big companies have a lot of cash, they're going to look to how do they maintain margins. And one way to maintain margins is to do mergers and acquisitions. So I think that will continue to stay steady, especially, we're seeing this diversion within the market, right? If you think about the biggest stocks in the market are outperforming. From mega cap are outperforming the S&P. The S&P is outperforming mid caps, and mid caps are outperforming small caps. So it makes sense if you have a currency, which is your stock, if you're a big company, that you can use that to buy some of these companies that are still down, as I mentioned earlier, 10, 15% off the high. So I think we'll continue to say that is a buffer for the overall market, and are likely to see that continue, especially if we see a slower economy and these companies want to see some growth in sales. They'll have to do it, outside of just organically by doing more mergers.
Yeah, Keith, when do you think, though, that we're going to get back to those more quote unquote normal levels? Is that something that we might not see until 2024?
As far as the mergers and acquisition side, or? Yeah, I mean, I think, one of the challenges is it's also more expensive to finance some of these acquisitions, especially on the debt side. So I think that we'll likely see that when we start to, when some of these companies feel more confidence on the other side, that they can see that the economy is going to find the low and move up on the other side, that they will, spend more capital to take over other companies. In the meantime, I think what you'll see is more bolt-on type acquisitions. But again, the big mega caps companies, a lot of them have cash. So I think they'll be looking from some larger ones. But in general, I think we'll see more of these bolt-on type of acquisitions.
Cash is king once again. All right, Keith, thank you so much for joining us today.